there, and welcome to the Retirement Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to have you here.
So let's dive right in. If you've ever thought that achieving financial independence is impossible on a low income, you're definitely not alone.
Yeah, it can feel overwhelming at times, but it's really about the strategies you put in place and the mindset you adopt.
Exactly. So today, we're going to explore some practical tips and insights that can help you plan for retirement, even if your income isn't what you'd hoped for.
We'll be talking about budgeting effectively, maximizing any available resources, and the importance of setting realistic goals, all of which can make a huge difference.
And we'll touch on some creative ways to supplement your income too.
That's right, Emily. It's all about being proactive and making the most of what you have.
So whether you're years away from retirement or already in it, there's something here for everyone.
Let's get started on this journey toward financial independence.
Yeah, let's jump into our first topic.
So Emily, one of the biggest reasons why achieving financial independence is crucial right now is that the landscape has changed so much. I mean, we're in a world where retirement timelines are shifting. People are retiring earlier, yet they're also living longer. That's a big consideration.
Absolutely, David. And with those longer lifespans, it's more important than ever to ensure that income can stretch over decades. I mean, think about it. If someone retires at, say, 62, they could potentially need income for 30 years or more.
Right, and that's where inflation really comes into play. It's like, if you're living on a fixed income, the rising cost of living can really dent your savings. Just last year, one of my clients, let's call him John, was really worried because he saw his grocery bills and utility costs creeping up. He didn't want to have to choose between essentials and enjoying his retirement.
That's a tough spot to be in. And it's not just groceries, right? Healthcare costs are soaring too, and that's a big chunk of a retiree's budget.
Exactly, and it's predicted that healthcare expenses can consume a significant part of one's retirement savings. For instance, another client, Mary, thought she had a solid plan in place until she faced unexpected medical bills. She hadn't accounted for the rising costs of prescriptions and regular checkups, which ended up being a real wake-up call for her.
That must have been really stressful for her. It's scary to think how quickly those expenses can add up. And speaking of stress, I think we also need to touch on the emotional side of financial security.
Oh, absolutely. I often hear from clients that the anxiety of not knowing if they'll have enough money to cover their needs is overwhelming. It can really affect their quality of life. Just last week, a couple I met with shared how they felt anxious every time they opened their bills.
That's such a relatable feeling. It's like you want to enjoy retirement, but that constant worry can overshadow everything else.
Exactly. And with market volatility, that anxiety can be exacerbated. The ups and downs of the stock market can really impact one's retirement investments. I've seen retirees panic because they feel their nest eggs are at risk when the market dips.
And that's where having a solid strategy becomes vital, right? You can't just rely on Social Security alone, especially with the changes happening there too.
Definitely. Social Security isn't what it used to be, and many people are realizing it won't cover their needs fully. I had a client, Tom, who thought he could live on his Social Security benefits alone. But when we ran the numbers, he realized he needed a much more robust plan to maintain his lifestyle.
That's a real eye-opener. So with all these factors, it seems like the need for tax efficiency in retirement planning is more relevant than ever.
Yes, being tax efficient can make a huge difference. Like, one couple I worked with, they were in a higher tax bracket during retirement than they anticipated because of how they had structured their withdrawals. That was a big shock for them and highlighted the importance of planning ahead.
It really does seem like every little detail matters, especially when we consider legacy planning as well. People want to leave something behind for their loved ones, but if they haven't planned properly, it can end up being a burden instead of a gift.
Exactly, and I always encourage clients to think about how they want their assets to be distributed. If they don't have a solid plan, it could lead to family disputes or unexpected tax implications for their heirs.
That's such a good point, David. And with the current economic trends, it's clear that having a comprehensive plan is not just a luxury but a necessity. There's so much uncertainty out there, and it's easy to feel overwhelmed.
Yes, and that's why I think it's essential to take proactive steps now. Many people underestimate the importance of having a financial cushion, and with the unpredictable nature of the economy, it's crucial to have that buffer to protect against unexpected events.
Right, and it's not just about the numbers. It's about peace of mind, knowing that you've set yourself up for success in your retirement years, and that you can enjoy your time without that constant worry hanging over your head.
Well said, Emily. And that's why we're going to dive into some core strategies. Strategies that can really help ensure that you're not just surviving in retirement, but thriving. All right, so let's dive into some strategies that can help folks achieve financial independence, even on a low income. One of the first things to think about is the importance of tax-advantaged accounts, like 401ks and IRAs.
Right, those are such powerful tools. When you contribute to a 401k, for example, you're not just saving for retirement, you're also reducing your taxable income in the year you contribute.
Exactly. This can be huge, especially for those on a tight budget. If you're in a lower tax bracket, contributing to a traditional IRA or 401k can really save you money on taxes. And then there's the potential for employer matching in a 401k, which is essentially free money.
Yeah, I always tell people, if your employer offers a match, it's critical to at least contribute enough to get that match. It's like a guaranteed return on your investment, right?
Absolutely, it's one of the best returns you can get. Now, for those who might not have access to a 401k, a Roth IRA can be a great alternative. With a Roth, you pay taxes on your contributions up front, but then your money grows tax-free. Plus, you can withdraw your contributions at any time without penalty.
That flexibility is huge. So for someone on a low income, they might be thinking, I can't afford to put away much. But even small contributions can add up.
Right, and let's talk about the power of compounding. Let's say you start with just $50 a month in a Roth IRA at a 7% average return. After 30 years, you could have over $50,000.
Wow, that's amazing. It really shows how starting early, even if it's a small amount, can make a big difference.
Exactly. Another important aspect is asset allocation. A common rule of thumb is the 70-30th rule, where you might keep 70% in stocks and 30% in bonds, especially if you're younger. This can help balance growth and risk.
So, stocks for growth and bonds for stability. But how does that change as you get closer to retirement?
Great question. As you approach retirement, you might want to gradually shift your allocation to more bonds and less stocks. This is often referred to as a glide path. The idea is to protect your assets as you get closer to needing to use them.
Right. And it's all about managing that risk as you age. Now, let's not forget about real estate. Many people think of their home as just a place to live, but it can also be a significant part of their retirement portfolio.
Absolutely. Real estate can provide income through rentals or even appreciation over time. If you buy a property in a growing area, you might see significant returns. And then there are tax benefits, like being able to deduct mortgage interest.
And if you're not ready to become a landlord, there are real estate investment trusts, or REITs, which can offer a way to invest in real estate without the hassle of managing a property.
Exactly. It's a more hands-off approach, and it allows for diversification within your portfolio. Now let's touch on Social Security. Optimizing your benefits can really make a difference in your retirement income.
Right, and knowing when to take Social Security is so important. If you claim early, you could lose out on a significant amount compared to waiting until your full retirement age.
Yes, for every year you delay taking Social Security after your full retirement age, your benefit increases by about 8%. So if you can wait until age 70, that could mean a lot more money in your pocket every month.
That's a fantastic strategy, especially for those who are in good health and can afford to wait. Now let's talk about withdrawal strategies. The 4% rule is a popular guideline, but it's not one size fits all.
Right. The 4% rule suggests that you can withdraw 4% of your retirement savings each year without running out of money. But market conditions and your lifestyle can really impact that. Some people might need to adjust their withdrawal rate based on their specific situation.
So it's essential to have a personalized plan rather than just following a rule blindly. And then there's the bucket strategy.
Yes, the bucket strategy involves dividing your assets into different buckets based on when you'll need the money. For example, You might have a short-term bucket with cash or bonds for immediate needs, and a long-term bucket with stocks for growth.
That makes sense. It helps to mitigate risk and gives you peace of mind knowing you've got immediate needs covered while still allowing for growth in the long term.
Exactly. And let's not forget about tax savings techniques. For example, using a health savings account, HSA, can be a great way to save for medical expenses while also getting a tax break.
Oh, I love HSAs. Contributions are tax deductible, and if you use it for qualified medical expenses, you can withdraw the money tax-free.
Right. And if you don't use it all, it can roll over year after year. It's like a triple tax advantage.
So, blending all these strategies, like using tax-advantaged accounts, optimizing Social Security, and smart withdrawal strategies, can really help someone on a low income build a solid financial future.
Yes, well said. But, it's also important to be aware of common pitfalls that can derail these plans.
Absolutely. Let's dive into those next.
So, Emily, one of the biggest pitfalls I see with folks planning for retirement is the sequence of returns risk. It's that danger of experiencing poor investment returns early on in retirement, which can really mess with a retiree's portfolio.
Oh, absolutely. It's like starting off on the wrong foot, right? I've heard stories of retirees who, right after they retire, face a market downturn, and it really hits them hard.
Exactly. I had a client, let's call him Tom. He was really excited to retire, but just a few months in, the market took a dive. He had planned to draw from his investments, but with the market down, he was essentially selling low. That can be devastating.
I can only imagine. So what did Tom do?
Well, he had to adjust his withdrawal strategy. Instead of pulling from his investments, he started relying more on his savings. It created a lot of stress for him, and he realized he hadn't planned for this scenario at all.
That's tough. So what's the takeaway here? How can someone avoid that kind of situation?
It's crucial to have a withdrawal strategy that considers market fluctuations, diversifying your income sources, maybe tapping into Social Security or annuities first during market downturns can help.
Right, and that leads us to another common mistake. Ignoring taxes when withdrawing funds.
Yes! Taxes can take a hefty bite out of your retirement savings. I've seen retirees who thought they could live comfortably, but once they started withdrawing from tax-deferred accounts, they got hit with a higher tax bracket.
Oh, wow. That's frustrating. I can see how that would be a nasty surprise.
It really is. Take Linda, for example. She had a solid nest egg, but she didn't account for the taxes on her withdrawals. Once she started taking money out, her tax bills skyrocketed.
Did she plan for that at all?
Not really. She ended up having to cut back on her spending, which wasn't what she envisioned for her retirement.
So what's the solution?
It's essential to have a tax-efficient withdrawal strategy. Think about your income sources and how they'll be taxed. A good financial advisor can help map this out. Planning your withdrawals can make a huge difference.
And then there's healthcare costs. Those can be a massive financial burden in retirement.
That's a big one, and many folks underestimate it. I had a couple, let's call them Jim and Susan. They were in decent health when they retired, but then Susan had a major health issue. They hadn't budgeted for long-term care or unexpected medical expenses.
That's heartbreaking. It must have been a real strain.
It was. They had to dip into their savings much quicker than they planned, and it caused a lot of stress.
So how can someone plan for healthcare costs effectively?
Well, I always recommend looking into long-term care insurance and setting aside a specific amount for healthcare in their budget. It's better to overestimate these costs than to be caught off guard.
Smart advice. And speaking of planning, another mistake I see is poor asset allocation.
Yes, that's crucial. It's not just about how much you have, but also how it's invested. I had a client, Mike, who was really conservative. He kept all his money in cash because he was scared of the market.
Oh no, that's a big red flag, right?
Definitely. While it's good to be cautious, he missed out on potential growth. When inflation hit, his cash wasn't earning anything significant, and he found himself struggling to keep up with rising costs.
So he had to change his strategy?
Exactly. We discussed diversifying his portfolio to include stocks and bonds, which can help with growth while still managing risk.
That makes sense.
And then there's claiming Social Security too early. It's like, people think they need to take it as soon as they can, but that can backfire.
For sure. I know people who claim at 62, thinking they're getting the most out of it, but they don't realize how much it can impact their benefits in the long run.
Exactly. I had a client, Sarah, who claimed early because she was eager to start traveling, but she didn't realize that by delaying her benefits, she could have received a much larger monthly amount.
So it's about weighing those short-term desires against long-term gains, right?
Absolutely. The longer you wait to claim Social Security, the better your benefits can be. It's crucial to factor this into your overall retirement planning.
So what are the red flags people should be looking out for when they're planning their retirement?
Great question. If you're not working with a financial advisor and you're unsure about your investment strategy, that's a big one. Also, if you're making decisions based solely on fear, like pulling out of the market during downturns, that's another red flag.
And not having a clear budget. That's a huge warning sign too, right?
Yes. If you don't have a plan for how much you'll need each month, it's like sailing without a map. You could end up lost.
So what's the next step for someone who might be feeling overwhelmed by all this?
Well, first, take a step back and assess your current situation. Look at your income sources, expenses, and investment strategy. And don't hesitate to work with a qualified financial advisor who can help you navigate these waters.
That's solid advice. It's all about being proactive and informed, isn't it?
Exactly. The earlier you start planning, the more options you'll have. And remember, it's never too late to adjust your strategy if you recognize those red flags.
Well, that's encouraging.
It is, and it's all about creating a roadmap that works for you.
Thank you for sharing all this valuable insight, David. This has been really eye-opening.
My pleasure, Emily. Always happy to help.
Let's transition to some next steps for our listeners.
So, Emily, let's dive into some actionable steps that our listeners can take right now to work towards financial independence, even on a low income.
Absolutely, David. It's really important to break things down into manageable pieces. So where do you think they should start?
A great starting point is to check out some online retirement calculators. Websites like Vanguard, Fidelity, and Schwab offer free tools that can help you figure out how much you need to save.
Yeah, I love those. They can give you a clear picture of your retirement goals and what you need to do to get there. But what if someone isn't sure about their retirement savings amounts?
Right, that's where Social Security can come into play. You can visit ssa.gov to see what benefits you might qualify for. Understanding that can really help in your planning.
And it's often a good idea to factor in those benefits when you're calculating your total retirement income. What about taxes?
Definitely important. Using tax software can help you get a better grip on how to optimize your income for retirement. It's all about keeping as much of your hard-earned money as possible.
That makes a lot of sense. And what if someone wants a bit more guidance, like from a professional?
Engaging with a financial planner can be really beneficial. Even if you're on a tight budget, many offer initial consultations for free or low cost. It can give you a roadmap that's tailored to your situation.
That's true. And for those who want to do their own research, are there any books or podcasts you recommend?
Absolutely. The Simple Path to Wealth by J.L. Collins is a fantastic read. It breaks down investing in an easy-to-understand way. For podcasts, The Mad Scientist covers financial independence strategies that can be very inspiring.
Oh, I love that one. It's so refreshing to hear real-life stories and practical advice. What about habits? What small things can people start doing today?
A good habit to start is reviewing your portfolio quarterly. Just taking that time to look at where your investments stand can really help you stay on track.
That's a great point. And running retirement projections regularly can also give you insight into whether you're on the right path, right?
Exactly. It's about keeping your goals in sight. And remember, it's never too late to improve your plan. Even small changes can have a big impact over time.
Yeah, I think a lot of people feel overwhelmed and think it's too late for them, but that's just not true.
Right. Starting small can lead to bigger changes, and developing a consistent savings habit, even if it's just a little each month, can make a huge difference.
And automating those contributions can help too, like setting up automatic transfers to your retirement accounts or savings.
Absolutely. Automation takes the decision-making out of it, which can help you stay committed. And don't forget to take advantage of any employer match if you have a 401k plan.
Yes, that's basically free money, and it's a huge boost to your savings.
Another effective tool is using financial planning apps. They can help you track your spending, savings, and even investments. Some popular ones are Mint, Personal Capital, and YNAB.
Those apps can really simplify everything, right? Having all your financial information in one place makes it easier to manage.
Definitely. And remember to set specific financial goals for short, medium, and long term. It gives you a clear target to aim for.
That's such a good strategy, and revisiting those goals regularly can help you adjust your plan as needed.
Exactly. Flexibility is key, especially when life throws unexpected challenges your way. So let's encourage listeners to take that first step today.
Yeah, whether it's running a retirement projection or simply logging into their retirement account to review it, every little bit counts.
So those are some practical first steps. Now let's bring this all together. Well, Emily, as we wrap up today's discussion on achieving financial independence with a low income, I think there are a few key takeaways that really stand out.
Absolutely, David. I mean, first and foremost, budgeting is just so crucial, right? It helps prioritize spending and identify areas where you can save more effectively.
Right. And then there's the importance of having an emergency fund. Just having that safety net can really ease a lot of stress in retirement planning.
Yes. And we also talked about the benefits of side hustles or additional income streams. It might not be easy, but those extra dollars can significantly boost your savings.
Exactly, Emily. And let's not forget about the power of long-term investing. Even small contributions can grow over time and really add up.
That's such a good point, David. And finally, we discussed the concept of living below your means. It's not about deprivation, but rather about making thoughtful choices that align with your goals.
Well said. And all of these strategies can truly help anyone build and protect their retirement wealth, regardless of their current income level.
So listeners, if you found value in today's episode, we'd love for you to like, subscribe, and share it with someone who might be planning for or already in retirement.
And don't forget to comment with your biggest takeaway or any questions you might have. We're here to help you navigate this journey.
Next time, we'll dive into how to create a retirement risk management plan. It's such an important topic, and I think everyone will find it really beneficial.
Yeah, planning for those risks can make a huge difference in your retirement experience.
Well, thank you all for joining us today. We hope you feel inspired and empowered to take charge of your financial future.
Take care, everyone, and talk soon.